Everybody, March 25th. It's a Wednesday. I hope everybody's having a very good day. We're going to dive right into it as we always do because we are about it. All right. My daughter hates that term. Welcome to the Morning BRRR. Hey, we have new slides. We really cleaned ourselves up. I am proud of us. Well, it is week 4 of the Iran conflict, and everything has escalated at once, only to de-escalate a little bit this morning. But really the key thing to be focusing on is that the United States has reportedly sent a 15-point plan to Iran through Pakistani channels. Oil crashing 4% after hours. It's down about 6% at the moment. Iran is suspecting a trick. Talks could come as soon as tomorrow. The U.S. Senate blocked War Power's 53-47 Kuwait airport drone attack as well, and the IDF striking Tehran. Moody's has increased its recession odds to nearly 50%. And the private credit crisis, continues to get worse. Morgan Stanley warning of an 8% default rate. We are going to talk a lot about what happened with Ares and, of course, what's happening with interest rate expectations. This morning in the market, pre-market numbers were up about 0.8%. The S&P 500 was at 6661. It's now about 6668. But hey, can't stay on top of everything, can we? This is the peace plan rally, or at least that's what they're going to call it as we move microscopic numbers, but it is what it is. This is a very good day for VWAP trading, looking for reversions, looking to just see how algorithms and how institutions handle this news. The VIX is back under 25, but remember, 24 is still elevated, down 3.5%. Of course, once again, replying to those headlines. WTI crude down around 87, Brent crude at 98, so we're back under $100. Bitcoin, that is a serious move. Just gonna say it. The fact that we are back above 71,000, that's signaling positive, more improving liquidity conditions. The 10-year note at 110, obviously gold sitting around that 4,500 level, and platinum at 1,900. We're going to talk a little bit about gold and silver momentarily because I do think silver is at its bottom, and I do like this area now to start speculating and analyzing ways to trade and get into gold. I'll explain why, and it has a lot to do with a report that I was reading 2 nights ago from the Bank for International Settlements. I'm going to dig deeper into that later today, but for right now, we'll start with this easier part. Okay, so gold's at 4,500, silver around 73. I am content to call a floor on silver around 65. Now, I want to point something out very simply. Silver prices moved higher for all of the reasons that we laid out in the Hedge of Tomorrow report back in March 2024. Monetary expansion, ongoing demand for metals. And here's the thing, without that move on gold to 5,500 and silver to 120, people who read that report 2 years ago would see silver is up about 200% from those levels, and they would be very content with those returns. The issue is that silver has fallen from 120 to 73 since January 30th. Now, a couple of things to highlight here. Okay, first off, silver prices went crazy because of speculation and because of a market mechanism. We're going to discuss that in a second. I just want to highlight something that is very important. All of those fundamental issues that we discussed, the industrial metal application, and of course, the fact that it kind of was the poor man's investment for the rise in gold prices, it all still holds. It still is a good thesis. But once again, silver prices went from 20 to 25 to $75 in roughly 2 years, and people are upset because other people are calling this a bear market for silver. Technically, it is, but who cares? Because it still is up 200% in 2 years. Okay, what happened to silver? I went through the Bank for International Settlements report. Nobody else has to do this ever. And again, if you ever tell someone tells you that they read the BIS report for the quarterly review, they are either crazy, lying, or going through something. Maybe I'm going through something. But that said, The thing that happened here was the ETFs. A financial product was responsible, according to the Bank for International Settlements, for that crash in silver back in January. Our momentum signal went negative on the 28th of January. Silver and gold crashed 2 days later, and momentum broke down the following week. All right. An ETF, so everybody knows, and one of the most prominent ones that you likely know is the SLV. Right, that's a trust. Forgive me. How about let's just do a standard ETF, just so that everybody understands. A standard ETF would just be something as simple as the SPY, right? So the SPY, is a basket of instruments, a basket of tools, a basket of stocks that you can purchase like a stock. It's simple. But a leveraged ETF, like the SPXL, which is a triple leveraged ETF of the S&P 500 or SPX, says, what if we did that, but we did it on steroids? Okay, a double leveraged silver ETF. And what ticker would that be? AGQ. Okay. This is the thing that blew up. A double leveraged ETF uses borrowed money to double your gains. So if silver goes up 2%, you make 4%. And if silver goes up 5%, you make 10%, and you feel like a genius. But here's the thing that the brochure around AGQ doesn't tell you. When it goes the other way, you lose double too. So if silver goes up or down 2%, you lose 4%. If silver drops 20%, you lose 40%. Okay. And because these products have to rebalance each day, they automatically will sell into a market that is falling just to stay in balance. Okay. That selling pushes prices lower, which forces more rebalancing, which forces more selling. It is a doom loop. Okay. Now, here's the thing about silver. Silver prices had doubled in 2025. See that run right here. We were back here with recommendation on silver. That's where the original report came from. It was around 25 bucks. This is 2025 in 2026, okay? It then gained another 50% in January alone. And the Bank for International Settlements said that the retail investors were the primary purchasers. Now, why does this matter? They were the ones that were piling into things like the AGQ, while institutional investors were actually holding steady or taking gains along the way on the way up. This is a huge warning sign in very plain sight. The idea that retail investing is just chasing these premiums. And the big problem was these ETFs were trading at premiums to what is known as their net asset value, the real sum of their parts. This is one of the reasons why I'm always cautious about trading things that are linked to futures, because when we got into speculation during the Ukraine war, the Tecrium wheat fund, that broke above its net asset value because demand was so one-sided that the arbitrage mechanisms in the market couldn't keep up. And if buying pressure outpaces the system designed to keep it in check, that's not a market anymore. That is a crowd chasing returns. Okay. So three things all happen at the exact same time back around January 29th, January 30th. Leveraged ETFs started their automatic selling. Exchanges started to raise margin requirements in the middle of a crash, forcing traders to either put up more cash or to liquidate their positions. And retail investors got a quote unquote margin called. They had to dump positions into the market that was already in a free fall. And silver lost 30% in a day. It was the largest drop since 1980s. And the BIS estimates that a drop of that size, this is interesting, would have required leveraged ETFs to sell about 3% of the entire silver futures market in a single day just to rebalance. And if you add on margin liquidation on top of that, that is where that avalanche came from. You'll recall, I famously, back on January 26th, After this moved up the way it did, I threw my hands up and I said, guys, I'm selling all of this, anything linked to paper on silver. I held my physical positions. But when things stop making sense, when things start dislocating from net asset values, when things are completely detached from any underlying fundamentals, remember, the purpose of a market is to sell. Add on the fact that we had a negative signal on the 28th. And by the 30th, it was not shocking to see this market absolutely behave the way that it can behave in periods of significant stress. All right, so gold is at 45.58. That leverage in silver has been unwound, and that's kind of where I want to start looking at names like Silver Wheaton, some of the gold miners, some of these other names, and we're going to keep a very close eye on momentum in the material space. And in order for me to really start to identify where I want to be, I want to look down in some of these names and maybe sell spreads, selling credit spreads, looking to find a place where I'm comfortable buying the stock. And what I might focus on, and I'll do a little bit of a video on this later today as well, is selling credit spreads. So I will pick a place where I will sell a put. I will buy a put under that level. And if the stock falls under that point, I'm going to take possession of it. If the stock doesn't, I'm going to pocket the premium and move on. And once again, this is a good strategy. I'm aiming for an 80% probability of success and at least a 20% return. And we can manage these things along the way. That's one of the things that we do at Insider Buying Report. We focus on CEOs and CFOs on stocks that we want to own, see where they're buying it, and look to sell spreads under where they are purchasing their stocks. All right, on the oil front, the E&P space is still very intriguing. You saw Devon Energy pushing above 50 yesterday. I've been talking about Devon as really my preferred play, but we've pulled back a little bit. And this is one of those spots right now where I think I got to think about maybe taking some gains. Truist just upgraded Devon. We're seeing a little bit of a pullback here. A lot of the news speculation, a lot of the noise, a lot of the retail may start to exit as well. And I have my eye very closely on the momentum gauge for energy over at Money Printer Pro as well. If that starts to go in the opposite direction, I'm not sticking around. I'm going to take whatever gains I have out of the E&P space, and which is the upstream oil and gas, and I'm going to put it back into my existing midstream holdings, which again, I continue to always argue and advocate. There is always money in the midstream. Trump set the 15-point plan to Pakistan to send to Iran. Talks could happen as soon as Thursday, and WTI pulled back on the news. Iran suspects a trick. They want J.D. Vance over Witkoff or Kushner, and they have denied direct talks. Senate, of course, blocking the war powers, Kuwait getting hit with a drone, and the IDF targeting infrastructure. CEOs are telling us quite a bit. Right? CEO of Shell pointing out that Europe could feel energy shortages by next month. Big hits on jet fuel, big hits on diesel coming next. Then gasoline as summer driving starts. Diesel's important because, once again, the refinery networks in the Middle East have been targeted. And here in the United States, we need access to more heavy sulfur crude in order to meet the demand of what our refineries have. The WTI and some of these lighter, sweeter crudes in Texas don't meet the create a refinery mismatch. So we'll continue to keep an eye on this. Diesel fuel is obviously the backbone of the U.S. economy. Everything touches a truck here in the U.S., so that will be very critical. Larry Fink pointing out that 150 per barrel has profound implications. A stark and steep recession would be the projection, and that's critical. We go back to the 1991 years. We go back to the periods of those huge spikes that we saw in 07, 08. Once again, higher energy prices trickle across the entire global supply chain. The world is built around oil, not the other way around. Years of $100 oil would remain a threat. He has two scenarios. One, oil falls below pre-war levels. Iran reintegrates and growth recovers, but that's a huge if. Or years of $100 to $150 per oil, a stark recession, and countries sprint towards solar and other renewables. And that is a very good point. Once again, the key thing to always keep in mind is that when prices elevate, incentives are put in place to create alternatives. Solar's unique. Obviously, we may see another revival again in the alternative energy space. If you're focusing on that, we always look at Brookfield Infrastructure and Brookfield Properties. Those businesses, particularly in the renewable space, are the best in class assets, in our opinion. All right, on top of this, ground forces have been ordered to the Middle East. 2,000 soldiers ordered, 2 battalions plus enabling units, joining 5,000 Marines already on the way. That's 7,000 combat troops in theater. The target allegedly is Karj Island. 90% of Iran's oil exports come through there, and they are also sending the 82nd. That is not for peacekeeping purposes. Nearly 1 in 2 groups, though, right? 1 in 2 are odds of a recession. Moody's coming out with the focus on recession probability at 48.6, which is way too precise for me. Goldman at 30%, Wilming's at 45%, EY, quote unquote, Ernst & Young, 40%. Everybody's going up on this expectation. Oil shock plus tariff chaos plus Fed paralysis means zero rate relief is in sight. But I will remind you that in the post-2008 world, we've had recessions last about a whopping 16 minutes because, once again, it's not really about recession focus. It's really about ensuring that there is ample capital in the plumbing of the system. And every time that system cracks and they inject more capital into it, surprise, surprise, we end up avoiding a recession. So even if energy prices are elevated and for some reason the Federal Reserve decides, you know what, we're going to pump money into the economy, or Congress gets drunk one morning and says, hey, let's just add $2 trillion in stimulus, guess what's going to happen? We're not going to have a recession. So keep an eye on monetary and fiscal policy. We talk about recessions all the time. We've had this conversation about soft landing over and over and over and over again. And it is kind of the boy who cries wolf. But at the end of the day, there's so much money sloshing around, and there's such a significant focus on government spending in the post-COVID era that level of spending has been what is responsible for keeping us out of a recession. Oh, and by the way, if we ever do have a recession, like we pretty much did in 2022, 2023, they'll just change the definition of it. Remember, they did that last time. So we'll see. All right. As you can tell, I'm always a skeptic. Aries making it 8. Congratulations, guys. Welcome to the party, pal. This is one of my favorite companies, ARES and ARCC in the BDC space. But here we go. ARES, $10.7 billion private credit fund, capped at 5% after 11.6% was requested. Apollo gated a day earlier. BCRED first loss in 3 years, down 0.4%. And of course, as you know, Moody's cut FS for standard KKR to junk status the other day. In Canada, $30 billion in private real estate funds have been gated. That's 40% of the total, and it just keeps coming. You see the list on the right. It all started with Blue Owl and the Tampa Bay Lightning losing a game 6-2. BlackRock, Stone Ridge, Morgan Stanley, Apollo, all of the usual suspects, and of course, Cliffwater, which we discussed in a recent piece, both in the Money Printer and in Money Printer Pro, discussing how that $33 billion fund was the quote-unquote canary in the coal mine, according to analysts. That said, Larry Fink's got something to say about it. The zero loss fantasy, according to CNBC, stating that the 8% default rate takes private credit from a zero loss fantasy to a normal credit class. So it is a painful but a healthy reset. The shadow defaults continue to rise. I'm going to go into depth on this today because there is way more money sloshing around offshore in shadow markets than I ever imagined. Once again, I noted that if you read the Bureau Bank for International Settlements monthly review or quarterly review for March 2026, I just stared at the wall for a good hour on some of the things that are going on. So I'm going to do a video on that today, the 5 big takeaways, the 5 things that made my eyes pop. One of the key things today was obviously what we discussed with silver, but the private credit side, particularly on the AI side, is absolutely staggering. That said, Goldman's worst case scenario is $105 billion in losses. That's a 5 to 6% cutback in new lending in addition to the private sector. And the reality is this, what investors are going to just start loading up on private credit, what fiduciary is going to tell people, hey, now's the time to start going into private credit? People would obviously be concerned about that. So as I noted in a recent article, I said really one of the key things here is the loss of trust at the institutional level. One of the core things moving forward is basically some of these funds may survive, but they're not going to be able to bring in new capital, and the relationships that they have with existing RIAs and other institutions is impacted. And this is one of the things that happened during the 2008 crisis. Although these are very different events, one of the key things to keep in mind was some of those real estate funds that persisted and survived post 2008, 2009, basically spent the next 3 to 4 years just selling off assets in a quiet kind of Coriolis effect spiral down the toilet. It just ultimately did not end well, and they ultimately shut down. That said, Larry Fink wants you to know there's a reason you're not getting your money back if you want to stand in line. He said there are rules, and you better live with it. He says this is not a 90-page or 68-page prospectus. It was a one-page prospectus. Well, once again, a reminder that very few people read anything that they sign these days. So yes, BlackRock, Blackstone, everybody else is going to say, hey, these are the rules that you agreed to. But that said, that is not going to benefit the long term for these fund managers who basically are telling people, yeah, you can't get your money back. Sorry. All right. On the signal front, we're still red. We've seen improvement. This is one of those days where we're looking at volume weighted average price. We're looking for the market to potentially squeeze a little bit higher today, just because it needs some relief, just because we need some short covering. Pay very close attention to volume, the RSI and the MFI on the S&P 500. The money flow index is the key thing to watch, which is known as the MFI. That is a momentum oscillator that combines price and volume. If the RSI is moving higher, but the MFI is moving lower, that is signaling that we have a lower volume rally, and that can obviously signal the possibility of reversals to the downside. If you want to keep up with the number of stocks that are breaking out versus breaking down, or the stocks that are breaking out and breaking down with full lists, including the new names that have hit the breakout list and the number of stocks that are falling off the breakdown list, obviously, please become a member of Money Printer Pro. Energy is the only sector that is positive at the moment, but that said, it is not just over yet. Like, what are we doing? Come on. There's got to be something that's going to be improving, right? This morning, technology is flat. Okay, so technology is equal, and the NASDAQ looking like it's about to squeeze. We've been bearish on the NASDAQ for 31 days. It would be wonderful to see this come to a close. All right, everybody, if you're not a member, once again, Me and the Money Printer is free. This is the free show. So we do this every morning before 8:30, goes out, and then I do a follow-up with Money Printer Pro readers. We go through the platform, we look for opportunities. And if you are a member of that, you get access to the platform. In addition to that, Postcards from the Edge of the World goes out once a week on Saturday or Sunday, with a portfolio update that happens on Wednesday or Thursday. This is a geopolitical risk and global market stories. This has a portfolio. The portfolio has done very well this year. I believe we're beating the S&P 500 by about 9 percentage points. So that's the S&P's negative, plus heavy dividend, heavy dividend focus. Wow. It's too early. I need more coffee. Insider buying reports available as well. We have opened up insiderstockbuys.com. That is now available for anyone who is interested. Other places out there will charge you $50 a month for the platform. We have not just a platform, but also custom emails and analysis that provides up-to-date insights on CFO and CEO insider buying. And we're only charging a whopping $9.99 a month because we want to make this accessible and continue to provide education on the insider buying space. All right, everybody, 8:10. I'm going to wrap it up. I hope you all have a great trading day. If you have any questions, obviously there is a comment section below. Do me a favor, share this with your friends. Take and like the share and like. Yeah, I haven't done this before. YouTube channel. Hey, it's there. And, maybe you go watch my show and you get distracted and instead you just watch Wu-Tang Clan. I'd be fine with that too. I hope everybody has a great day. We'll catch up on the other side. Take care.